I'm Sam Slater from Fund Calibre, and today I've been joined by Alan Dobbie, co-manager of the Rathbone Income Fund. Hi, Alan.
Hi, Sam.
So perhaps we could start with UK dividends and whether we're seeing a good recovery from last year and some special dividends paid, or whether companies are still lagging behind. What's happening?
Yeah, so dividends from UK companies have really rebounded incredibly strongly over the last year or so. It's been a much faster pace of recovery than either we or the market expected, and that really ties in with the shape of the global economic recovery that we've seen. It's been much more of a V-shaped recovery than many of us expected. Maybe 12 months ago. I'm not suggesting by any means that we're out of the woods yet. Clearly, COVID is still with us, and the economic risks and uncertainty that come with that are still there. But we are seeing a strong global economic recovery. We're seeing a strong UK economic recovery, and UK dividends are really just being swept higher on that rising economic growth, on rising earnings forecasts from UK companies. Just to put some numbers on it, UK dividends were cut by almost 40% in 2020. Looking at consensus numbers, expectations are for dividends, including special dividends, to grow by about 25 to 35% this year. So it's a phenomenal recovery, really, coming from a year of cuts, but a phenomenal recovery. If we think about where the growth is coming from, there's a bit of everything. You've got some companies which had paused dividends are now reinstating them. Some of them are making up for those the missed payments by issuing special dividends. But you've actually got a lot of companies who traded really well through the pandemic and are still trading well, and they're putting through genuine dividend increases, returning surplus cash flow to shareholders. One example I should just mention actually is the mining sector. It's companies like Rio and BHP have had an astonishing year from a financial perspective. Certainly, high metal prices mean that they've got these huge excess cash flows. They're returning most of those to shareholders and actually supercharging dividend growth this year. It creates a really high bar for dividends in 2022. So we're having to keep an eye on that for mining sector dividends in 22, especially with the news that BHP might be leaving the FTSE index next year. But all in all, we're going to see exceptional dividend growth in 2021. So it's a good positive message for UK dividends this year.
So why is BHP leaving the FTSE 100 then?
So they put out an announcement a couple of weeks ago that they were considering consolidating their UK and Australian listing, and FTSE Russell are still consulting on whether BHP will continue to be included in the FTSE All Share Index. The company will retain a London listing, but it may not retain its all share listing. All these things are potential. There's a lot of moving parts in there. We still think it's an attractively valued business. It's retaining its place in our fund, but there's a lot of things to consider for the BHP investment case at the moment.
And sort of going back to the UK as a whole, how long do you think it will take to get dividends back to pre-pandemic levels? Or do you think that companies are going to keep dividends a bit lower for longer, and is that necessarily a bad thing?
Yeah, so as I said, we're expecting good dividend growth in 2021 at a headline kind of aggregate level, but it's still going to be a good bit below 2019's level. Just taking it down to a stock level, within our fund, just over half the companies that we hold are currently paying dividends above their 2019 level. Unsurprisingly, that's your steady Eddie dividend aristocrat type companies in utilities, healthcare, consumer staples, and the mining sector, as I said, more cyclical, but paying big dividends. At the other end of the spectrum, within the wider market, you've got some companies that haven't yet returned to the dividend register. Mostly these are companies which are still being heavily impacted by the pandemic and lockdown. So retailers, restaurants, cinemas, airlines, holiday companies. That's your extremes, kind of at either end. In the middle, you've got a whole load of companies which are paying a dividend, but it's either a bit less or a lot less than in 2019. The oil sector is currently, that got a lot of headlines when Shell and BP cut the dividends last year. They both put through dividend increases recently, but their overall dividend level is still only about 50% of where it was in 2019. The banks are paying about 30 to 40% of 2019 levels. A lot of industrials took the opportunity to rebase back then.
And the fund itself has one of the best track records of raising its dividend in the UK equity income sector. I think it's only cut twice, once in 2008 and once last year. How's the fund's dividend recovering? I'm presuming from what you said that you're hopefully expecting it to be rising again this year.
Yeah, so a key objective of our fund is to provide an attractive dividend which rises ahead of inflation over time. As you rightly said, we've got a good track record. We've increased the dividend in 26 of the past 28 years. Dividends from the underlying holdings have been recovering really well this year. I mentioned the miners, they've been astonishing. Banks are back to paying dividends. House builders have actually been really good, robust payers this year. The UK housing market's still very healthy at the moment. So we're expecting really good dividend growth in 2021. We've planned out what we expect to receive in terms of dividends next year as best we can from what we know at this stage. And it's fair to say that we're not expecting another year of kind of the supercharged dividend growth we're seeing in 2021, but we do expect another year of dividend growth. And of course, that will be coming from a higher level. If we put through a big increase in 2021, that will be coming from a higher base. So all in all, it's a really positive outlook in terms of the Rathbone Income Fund dividend.
And just lastly, around 2/3 of the portfolio is currently in FTSE 100 companies. Why is that?
Yeah, so 2/3 in FTSE 100. We have about 10% in large cap non-UK companies, just under 20% in small mid caps, UK small mid caps. In truth, market cap is not a real focus for us. We pay a lot of attention to liquidity. That's important. We're really hot on that. But that's a related but slightly different issue. But market cap's not a key input in our stock screens or our process. And the reason for that really is that we believe that one of the best things about our fund is that it has the ability and we have the freedom as managers to invest up and down the market cap scale and right across the style spectrum, from value and cyclicals at one end to kind of more defensive or growth businesses perhaps at the other. And we think that's a really valuable attribute for our fund, rather than being anchored to a view that mid caps are always going to be the best thing to invest in, or quality growth is always going to be the best thing, irrespective of valuation. So at the moment, our bottom-up work is leading us to have 2/3 of the fund in the FTSE 100. That may not always be the case.
That's great. Thank you very much.
Thanks, Anne.
And if you'd like to find out more about the Rathbone Income Fund, please go to fundcalibre.com.